talk about today is the CalSavers. Ooh, I just got my recording in progress button going here. And we're going to just basically talk about the law. I would say it's a new law, but CalSavers and the burden it's going to put on us as small business owners. And like usual, a couple days after we get this thing recorded, we'll throw it up on the YouTube channel if you miss it or if you have follow-up questions on it and stuff like that. So I'm going to figure out how to share my screen because I'm still 3 years into Zoom or totally inept at this thing. So let's see if we get this going here. So basically, CalSavers, like I said, and what Chris and I really want to go over today is what is CalSavers, who must comply, the deadline, which is the most important thing because that's June 30th, what exemptions are, and that's why I brought Chris on here because California is going to force us as employers with 5 or more employees to set up retirement plans. If we don't voluntarily set one up, through a financial planner like Chris, the state's going to make us set it up through California. So we want to really focusing on the exemption portion. If we don't set anything up, there's pretty big penalties. And then if you do decide to opt through CalSavers, I have the web link here for you and stuff like that. So what is CalSavers? A lot of you probably don't remember it, but CalSavers was actually passed back in 2016. It was Senate Bill 1234. And then it took, a good 5 years for it to fully phase in. Employers with over 100 employees phased in earlier, and now it's hitting the rest of us, 5 or more employees. So this has been on the books since 2016. I think most of us just were silently hoping that it would just disappear and die off, but it didn't. So, so who must comply? Basically, if you have a business in California, whether you're a corporation, LLC, sole proprietorship, partnership, if you have 5 or more employees in California, you need to have a retirement account set up, unless, of course, you are the government itself. So almost everybody, that we have as, companies are going to need to have some kind of retirement plan set up. I want to point out, because this is one of those things that, I promote employing our family through our business and stuff like that. If we have our children on payroll, they're going to be employees for, CalSavers, purposes. So, it's something you need to be aware of. So like for myself, if I have my spouse and my 2 kids and me, that's 4 already. I only need one other person before I trigger the CalSavers requirements. So just be aware of that. What is an eligible employee? And this is part of that code that gets really confusing. You need 1 eligible employee and 4 technically non-eligible employees as far as the law is written up. And eligible employee is a person that's at least 18 years old, has a status as an employee under California, and receives a W-2. So basically, if they receive a W-2, they're an employee for purposes of the CalSavers bill. So the deadline, this is what I really wanted to have this out. I apologize, but I wanted to get it out earlier. But our deadline to have something put in place is June 30th, which is all of 2 weeks away. So I'm sure Chris will be busy in the next couple of weeks, waiting for us, last minute, people that need to get something set up. But put it on your calendar. It has to be set up. If you fail to set it up, the penalty is $250 per employee, and it could go as high as $750 per employee. So what are some of the exemptions? And this is what I really wanted Chris to talk about on here. And I got his slideshow somewhere. If we already have a retirement plan set up through our business, a 401k, a qualified plan like a profit sharing or defined benefit plan, a SEP IRA, or what I'm going to have Chris talk about, a simple IRA, 403b, 457s, all those type of plans will exempt us from having to participate in CalSavers. And what I really wanted to bring Chris on, because to me, it's the simplest, pun intended, plan that we could set up as employers that costs us the least amount of money to get away from having California manage our retirement plans. So Chris, I'm going to get ready to share this, but if you could introduce yourself, that'd be great.
Yeah, absolutely. Thanks, Steve. My name is Chris Kyra. I own my company, Advisor Resource Group, and we specialize in working with physicians and dentists and putting together comprehensive plans. And in one of those areas, we specialize in retirement plans. And so in doing that, we sit down with the clients, kind of understand their goals, their short-term goals and long-term goals. And so for a lot of our dentists that have smaller practices, meaning 20 or even 10 or less employees, we would set up a retirement account. And the one that we typically set up that we start off with is a simple IRA. And so the difference between the simple and the 401k, and Steve will show it on the screen so you can follow along, but basically they're both pre-tax plans. So when we put our money in there, we get the deduction up front. The 401k, we could do 20,500, but because,
sorry about that.
oh, no problem. Oh, perfect. With the 401k, when you set that up, you have to hire a TPA, which is a third-party administrator. So if you're a practice that just started up, or you already have a lot of deductions going in and you're not going to be contributing the full 20,500, the 401k tends to be a pretty expensive plan because of all the administration fees. So you're talking the TPA fee and everything else, you could be up to $2,000 to $2,500. And if you're putting away 20,000, I mean, that's 10% just in fees. So what a lot of our clients like to do is do a simple IRA, and this is with one of the mutual fund companies. So whether it's a simple IRA or simple IRA plus, it'll be anywhere from $10 annual fee to $25 annual. And each participant pays that fee, just comes out of their account. So as the employer, you're not paying, you're just paying for your own $25 fee. And it gets invested just like a 401k. The only difference is with the simple IRA, not only the fees are really low, is you can't put in as much as the 20,500. It's about $14,000 per year. And then you got the catch-up provision if you're beyond 50 years of age. But it's a great plan to have set up because just like the name entails, it's simple. It really is simple. There's no third-party administrator. You don't have to have someone review the numbers as far as it being compliant. It's literally a dollar for dollar match up to 3%. So what's nice about that is your employees have to have stake in the game. If they put in $0, you don't have to put any money into that plan, such as a 401k. Some of the safe harbor rules, you have to put money in regardless whether your employee contributes or not. So we like the simple IRA to start off, and then as you guys make more money and you want to put away $50,000, $60,000, $70,000, then we start going into these 401k profit sharing plans. But for the call right now, the simple IRA is really nice because of that. And you can invest in whatever you want as far as we typically just go through one mutual fund company to keep the fees really, really low. The other thing from the simple IRA, you really can't borrow from it. And the 401k has a nice feature that you can borrow from it, but it ends up actually hurting the employees. So a lot of people will take money out of their 401k because they want to buy something. And it actually is the most expensive way of borrowing money. The simple IRA won't even allow you to do that. So that's kind of nice. It kind of gives you that administrative headache, the relief of having to do the loan. Oh, perfect. Yeah, 14,000. Then you got the catch-up provision of 3,000 for if you're 50 or older. So yeah, so if I'm an employer and I'm only put away and I make on paper, let's say $200,000, I could put away $14,000. Plus, I'm going to match 3% of my own money of the 200,000. So that's 6,000. So I'm putting away $20,000, which is the same as a 401k, but it only costs me $25 a year instead of $2,000. What else can I say about this simple? Oh, the other thing you want to take a look at is like the investment choice. Being a broker, we can invest in any mutual fund company that's out there. I think it's important to understand what kind of investor do you want to be? Do you want to be a passive investor or do you want to have an actively managed portfolio? The fees are virtually the same on both sides. I prefer specifically actively managed, especially when the market's volatile like it's going right now, or passive. If you're down 40% because the market's down 40%, you're kind of going down with the ship. Where if you have an actively managed portfolio, they're constantly moving the money around. So it kind of gives you that downside protection that you don't lose as much. Now on the flip side, when the market goes up, you're going to do whatever the market does. So long term.
That's a good point, Chris, because with CalSavers, and correct me if I'm wrong, basically we are giving our money to the state of California to actively manage for our employees. And if anybody knows how California does, it's probably not the person we want to have managing our money for retirement purposes. Is that right?
It is, yeah. And what's frustrating, Steve, with the CalSavers, a lot of them, they use, they'll just put people like in target date funds, which if, you don't really follow the stock market, that I call it the lazy way of investing. You can just put your money in there and just put it and just have it sit and cook. And so if you do a 2050 fund, as an example, they're assuming at 65, all right, in the year 2050, you're going to be 65 years of age. And then as you get closer to that age, the fund just gets more conservative. The problem is they're not using the best target funds out there. They're using the CalSavers target funds. And what else is frustrating is you have no choice of the investment. So what happens is, I'll just pick Fidelity funds. Everyone's heard of Fidelity funds. So Fidelity funds has 300 mutual funds you can invest in. Well, not every single person invests in all 300 Fidelity funds. There are some funds that they're not good and people don't put their money into it. Well, what happens is, what Fidelity does is they'll put some of those funds in there, like their low price stock fund as an example. They'll put that fund in there and they'll make you invest 20% of your money in that particular mutual fund, whether you want to or not. CalSavers is going to do the same thing, and it could be funds that you don't want to invest in. We talk to a lot of clients that want to be socially responsible. We don't really want to invest in gun companies or tobacco companies. Well, if you set up your own retirement account, you can custom design that, which is really nice. Where with CalSavers, it is what it is. Whatever they offer, you're stuck with them.
Yeah, it just seems like a simple choice to me, because do you really want to have the people that gave out $40 billion in fraudulent EDD funds managing your money, or, manage it yourself or hire a professional like yourself? It just seems like it's a no-brainer to me, especially since I think CalSavers, there's no fee to the employees versus $10 or $25 a year. Like it's not a big thing to have it, professionally managed or taken over.
Correct. I always joke, CalSavers, that, just go to the DMV, and try to renew your license or do anything at the DMV. That's who's managing these types of accounts. And it's you kind of get what you pay for. It's very frustrating trying to get someone online if you have questions, compared to working with, a broker that's going to customize it for you. And then what's nice is you could always move it. You can go start off with a simple and then move it to a 401k where you could deduct 61,000, or a cash balance account where you could do 300,000. You don't have that kind of flexibility with the CalSavers. It is what it is. It's in there and it's turn a blind eye, and whatever they say, that's what you have to do.
And I just want to make sure that people understand, I'm only having Chris talk about simple IRAs because it is the simplest one to set up, and it's the least expensive. But employers have, and I've mentioned this in other videos, there's literally tens, 20, 30 different types of retirement plans that individual owners can set up. And I always say that's one of the better things about being self-employed or a small business owner, is we could control our retirement, right? Like I could set up a defined benefit plan to pay me a monthly income when I retire, or I could put more money into, cash balance plans or something like that. That if I'm an employee with Cisco, I'm stuck with whatever Cisco is going to offer me, right? So that's the nice thing. But I just wanted him to focus for today on just getting something set up in the next 2 weeks that isn't relying on California.
For sure. And the other thing too is, the government's forcing us to do this. So, with the job market being so competitive, and I've talked to quite a few dentists that are struggling, hiring good talent, or even if they have good talent, keeping them, because they're either moving or they're going to another shop. Having a retirement account where you're saying, hey, look, we're investing in you. We care about you. We want to make sure that not only do you work hard for us, but that you're putting money away for your future and for your family. So we're going to match dollar for dollar up to 3%. That's pretty awesome, because some of these other plans that some of our clients will set up, they're like, well, I don't want to do a match. It's like, yeah, then not a people are going to participate. And so with that 3% match, it's like, look, you make $50,000 as an employee. If you put in 3%, that's $1,500. I'm also going to give you $1,500. So you're guaranteed to double your money. That's a perk. That's a benefit. So when you're interviewing new talent, you say, yeah, not only do we offer health insurance and a great work environment, we also offer a retirement account where we're going to match dollar for dollar for 3%. And they think it's the greatest thing in the world, which it is. And it's only costing $25 a year. I mean, it really is an easy plan. And then, like Steve said, as you grow, there's all these other plans that you can do. Or if you have a really good, like a junior partner, and you want to make sure that they're taken care of, you can set up special plans, like key stuff just for them. And so instead of golden handcuffs, we call it platinum handcuffs, so they're not shopping around, because then if they leave, they're losing out on a lot of money.
That's good. So obviously, if you guys have any questions for Chris or myself as we're going through this, feel free to either type it into chat. I think there's only like 5 or 6 of us on here. So if you want to unmute yourself and ask a question, feel free to, and we'll try to get those things answered for you. Let me share the screen again and we'll get back onto the presentation here. I'm not going to make it full screen for you, but you should be able to see it. So as like we talked about, the exemptions are obviously under 5 employees. And then setting up your own responsible plan through your business. And I'm a anal type, control freak. So I really don't like giving control away to the state or a taxing authority when I can control the investments myself. So I mentioned the penalties earlier. It's $250 per employee, or as high as $750 if it goes more than 180 days and stuff like that. This could be an annual penalty. So the longer you keep it up, the more the penalty is going to be. And if you think about it, I mean, if you have 1 month of 5 employees that you don't set up a plan, you're out $1,300. Whereas setting up a simple IRA, even if you reimburse the employees the $20 or whatever it is to set it up, it's going to only cost you $100. So much better to do it yourself and try to get something set up ASAP, just so you're not getting hit with these penalties. Registration, pretty easy. You just go to CalSavers, website, and you could go in there. I think as a business owner, you actually have to go into CalSavers anyways and let them know that you have a separate plan set up and what type of plan that is, just so they don't harass you. So get registered on there. I think they sent out letters a while ago to employers to register or opt out. Like I say, I'd go on there, let them know that you have a simple IRA set up, and because this is going to be an audit, right? It's going to be pretty easy for them to get a database of every corporation, because that's through the Secretary of State, every business owner, because that's going to be on your California tax return, right? Whether you're a Schedule C business or you have a K-1 flowing through, they're going to know what businesses are out there. And to me, it just seems like easy money if you're the Franchise Tax Board or the EDD trying to collect money, right? No, I didn't see this business registered. Here's the letter going out and here's their penalty, right? So it's going to be pretty straightforward. They're going to be able to calculate your penalties right off the bat too, because you file payroll tax returns. And part of the EDD's payroll tax return specifically lists out the employees, because they collect a tax on the first $7,000 of wages. So it's going to be an automated program that's going to start sending out letters and collecting money from you. So get it set up as quick as you can. I don't know what Chris's availability is for doing this stuff. I'm sure he could be swamped in the next couple of weeks trying to get everybody set up on the last minute stuff. But it's something you need to do to avoid these penalties, because you just don't want to be on the radar of the EDD or the Franchise Tax Board, because who knows if they think you're messing up on this, do they open it up for a payroll tax audit to see if there's any other independent contractors that could be reclassified? Do they refer to the Franchise Tax Board now that you got you in the system for maybe an income tax audit? So let's just keep off the radars. Let's get registered. And like I said, the simplest thing you could do is set up that simple IRA, whether it's through Chris or another organization.
And that's a good point, Steve. I mean, you've always said, the IRS, they're not dumb, they're just slow. Eventually you will get caught, and then they could just go back 3 years and say, oh, okay, yeah. And then we're going to add a 10% penalty on top of that. So instead of 1,300 times 3 at a 10%, now your penalty is $7,000. And it's like, what? It doesn't make any sense.
It doesn't. And like I say, it's something that's really easy to avoid, right? My firm itself, we have a simple IRA. Basically payroll takes out the money, payroll submits it to the plan. It's something that's pretty easy to do. And the next screen's pretty funny. Cons: it is created and run by the state of California. Like, you don't need to really say anything else. I mean, just look at our state and say, do I agree with the way it's being run? And do I want these people managing my employees' retirement account? And the pros, it's supposedly free. You know, really, that's all you get out of this whole, law that's being passed. And I didn't actually talk to Chris about it, but the investment they're giving you, like this retirement account, is something that every individual could set up on their own had they wanted to. Really, it's dumping you into a traditional or a Roth IRA. I'm not sure which one it goes into, but it's an IRA. It's a $7,000 limit, I think, on the investment that goes in there. If really our employees wanted to save for retirement, wouldn't they just go out and set up their own investment on their own, right? But now we're going to have the state managing our business and our retirement accounts. We're going to have certain reporting requirements. We have a new employee and everything like that. I'd much rather have that simple IRA. If the employee doesn't want to participate, it doesn't cost me $1, right? They're just going to opt out, and it's in my control. So, as you can tell by the tone of this thing, I am totally against CalSavers. I think you need to have something else set up for you and your employees. Here's the website, calsavers.com. Like I said, if you need to register or opt out. So if you're going to opt out, go on calsavers.com, register your business, and tell them that you have another plan, simple 401k already installed. So here's Chris's information. So like I said, I'll send this out to the people that registered, so they have Chris's information. Like I said, I can't encourage you enough just to go out there and get that simple IRA set up before June 30th. Now, at the end of the year, if you want to put in more, you got that 6 months to make that decision. But we're sort of down to a deadline of 2 weeks for those that haven't already done something to get something set up. Chris, do you have anything else to really add into that?
Yeah, so what happens is once you set up the plan, we can always change it the following year. So once you set up the simple this year, you keep it for the tax year 2022. And then 2023, if something's changed, hey, we actually made more money than we thought, we want to put more money in, we could just set up a different plan. You just can't have the same two plans in 1 year. So once you set up one, you're in, which is a good thing, is because you're putting money away. And I think the one thing I would add, Steve, is just, everyone's kind of leery what's going on with the market, right?
Yeah, I didn't want to really bring it up that we're talking about retirement plans, and the market, I think, was down 4% today, and watch people jump out a window or something like that.
I know, and what's crazy is it's kind of, you want to do the opposite. I mean, I don't know everyone's age on this call, but this is a great time to buy. When you win when the market's down. When the market's going up, everything's really expensive. So it's a kind of a good time to put money, especially when it's going down, because all of your goal is to buy as many shares as possible. How you want to invest, we can set it up based on your risk tolerance. That's what's so cool. Each individual person, each employee, employer can set it up whether they want to be really aggressive or really conservative. So a lot more flexibility.
So do you guys have any questions and stuff like that on this? Again, I think the big highlights are CalSavers is for 5 or more employees. It's a forced retirement plan that you have to offer to your employees. You have the option of not going through them if you set up your own retirement plan through somebody like Chris. And there's penalties associated with it. And the big thing is you got to make this decision and have everything in place by June 30th, really. So you got 2 weeks to get your business set up and have this all taken care of. So I don't see any.
It does take I will say, it doesn't happen overnight, but if the paperwork's dated and it's in process, that should suffice if if you get audited. But it does take a good 2 to 3 weeks for everything to get approved. Because it has to go through broker dealers and everything else.
And we had one question in the chat, and it's basically, I have 4 employees. Being the owner, Dennis, I am not enrolled in payroll. It's going to really depend, because if you are a corporation, but you're not on payroll, remember corporate law says we have to pay a reasonable salary to the owners of the business. So if you have your own corporation and 4 additional employees, yes, I would say you probably should get set up, because you'd hate to have that trigger it And then they come back in and say, by the way, over the last 6 years, you were supposed to be on payroll, and now we're going to come after you for payroll taxes on a salary we're going to make up for you.
And that's EDD stuff. Those guys
Yeah.
are worse.
So if you're self-employed, I'm a Schedule C, I don't have a corporation, and you only have 4 people on payroll, I don't think technically you have to, because you're not issuing yourself a W-2, technically do it. But I would err on the side of safety because, like I said, I didn't look at all their regs or if there's been any rulings on whether, remember, because it takes one qualifying employee. So one of your people triggers the requirement. Do they count the self-employed individual as an employee at that point? Because you are paying into pay taxes on a schedule, if that's going to trigger it for you. So I would say, set up the simple IRA just to be overly cautious, because I just don't want the government looking at any clients or anybody else, because I just think it opens up a huge can of worms, especially on payroll, which is probably the #1 issue going into 2022 through 2030, right? Everything you hear is Social Security's on the verge of bankruptcy. Medicare only is going to expire in 2032. Those are all funded by payroll taxes, right? So, you just don't want these agencies looking at your payroll and, potentially saying, hey, by the way, there might be an open issue here that we could get more money on. So I would say err on side of safety for you and yourself. Go at least opt out, say you're setting up a simple IRA. So I hope that answers that question, a long-winded answer. Anything else from anybody? Kristen, sole proprietors could open up simple IRAs, right, for their employees?
They could. Yeah, absolutely. Yeah.
So
Yeah. If you're a sole proprietor, and you don't have any employees, I would look at either doing a SEP IRA or a single K.
yeah.
A sole proprietor that doesn't have payroll, then a SEP. But if you're doing a payroll, I prefer single Ks. You could put a lot more money in, and the fees are exactly the same. So to me, a single K would be more efficient if you're paying yourself a payroll. If you're not, then a SEP's super easy.
Perfect. Okay, so I think that's it. I didn't see any other questions. I want to really thank Chris for coming in. I know it's a busy day and stuff like that. So like I say, if you have questions on how to get that simple setup or SEP or 401k, give Chris a call. If you need his contact info, you didn't have enough time to get it down, just reach out to me and I'll get it over for you. So thank you very much. And like I say, we'll talk soon. Okay. Thanks, Chris.
No problem. Take care, guys. See ya.